Peace and love, good people. Peace and love. So let's get right back into it. Consider joining the Patreon, link in the description. All right, we have a starting charting video series designed to help new investors and traders learn to chart, the fundamentals of charting and technical analysis. Trust me, you don't want to miss it. All right, join now, because once this thing starts cooking, the price is going up. I'm not gonna lie to you. Yesterday's price will not be today's price. I'm sorry. Yeah. How does the saying go? Today's price is not yesterday's price. Or tomorrow's price is not today's price. Y'all get the point. The idea of it is that, I'm coming with more value. I'm increasing the value. I'm trying to increase my impact. I want to definitely make a difference in your trading journey. It's never too late to learn. I want to model that. I want to represent that. You can learn and get started at any time. And I want you to join the Patreon, participate, and be a part of greatness. All right, with that being said, let's get into Delta and how Delta positively impacts options decisions and probability. So, what is Delta? There are 3 definitions of Delta, which are all true. 1. It is the expected change in the value of an option's price for a $1 move higher in the stock. Let's go knowledge base in E-Trade. I like that. Breaking it down. Give me the simple breakdown. I need 3 definitions of Delta. Number 2, it is the approximate probability that at expiration, the stock's price will be higher than the option strike price. Fire. Number 3, it is the price risk percentage of stock ownership that is currently represented in the option. It is the price risk percentage of stock ownership. So if it's a 0.60 delta, it is the expected change in the value of an option's price for a $1 move higher in the stock price. So for every $1 it goes up, a delta of 0.60 is going to move up 60 cents or $60. So if the stock goes from $50 to $51, the value of the option should go up 60 cents. So if you bought it for $2.50, the value after a $1 stock move would go from $2.50 to $3.10, meaning you would go from $250 in value to $310 in value. I get that. Number 2, it is the approximate probability that at expiration, the stock's price will be higher than that option's strike price. So a 0.60 delta says that there is a 60% chance or probability that whenever the expiration date does come, if it's 60 days out, that the price will be higher than the option's strike price. So if I buy a call for the $100 strike price 60 days out, and it has a 0.60 delta, there's a 60% chance that 60 days from now, the stock price might be $101, $102, $103, $120, $150. But it's a 60% chance that it's going to be higher than 100. I get that. Number 3, it is the price risk percentage of stock ownership that is currently represented in the option. It is the price risk percentage. I don't understand that one. Okay, I don't understand that one. It is the price risk percentage. If you understand that, please comment down below and help us out, because we are trying to explain it and retain it, and I can't explain it, so I don't understand it. All right. These definitions, however, are only as good as the models upon which they are based, and outcomes are subject to changes in market conditions and volatility. So they're only as good as the models upon which they are based, and outcomes are subject to changes in market conditions and volatility. Okay. only as good as the models upon which they are based. The third definition in particular is oftentimes here we go, they're going to break it down for us. The third definition is oftentimes a useful indicator to help determine which calls to buy. So the part I don't understand is very helpful. All right, that's interesting. You can use the options delta to determine what percentage of price risk you want to take versus buying the stock outright. If you buy a 70 delta call, you have 70% of the price risk versus owning the stock outright. If you want a greater amount of price risk, you can use a higher delta call. If you want less risk, you can use a lower delta call. Too often, new option traders buy out of the money options because they cost less. They think they're getting a better deal, and they can buy more calls at a cheaper price. However, while the premium may be relatively inexpensive, remember that their probability of expiring in the money is very low, according to the second definition of delta above, which also means that the probability for a successful trade is also low. Once you have decided which calls to buy and have purchased them, you do need to monitor your position. It is important to note that you do not need to wait until expiration to see what happens. You can always unwind or close your options position before expiration. Just because there's an expiration date attached to the options trade, it does not mean you have to hold it until that date. Facts. If the trade is profitable and you want to take your profits earlier than expiration, then do so. You can do that. Conversely, if you experience losses on the trade and you want to limit further losses, you can also just close the trade. You can close the position. The stock replacement call is a way to maintain positive exposure to an increase in a stock's price while limiting your risks in the markets and utilizing less cash to do so. All right, open an account to start trading options or upgrade your account to take advantage of more advanced option trading strategies. E-Trade, I see what you did there. That was good. So now I do understand the third one. All right, so the higher the delta, the more of a L you take, but the more of the gain you take. So it's all basically number one is just number three is the inverse of number one. And it's highlighting the fact that the higher the delta, the more ownership you actually have. All right. So it's a weird dynamic. Like I can't tell if they're encouraging you to buy options, giving you insight to the negatives and cons of buying low value options. But the way they worded number three is enhancing the focus on risk and not the expected change. But I guess that's what they're saying. It's like number one is the positive. You can expect the change with the move higher. You can expect positive things with the move higher based on the delta. But you also, the higher the delta, the more of the ownership role you're simulating, which means you risk more as well. And we're talking about the probability that if you held it to expiration date, the price of the stock would be higher, but that doesn't mean that the value of your option would be profitable. So don't let that go over your head. So that's delta in a nutshell. That was very insightful. Make some noise for the knowledge base. That was good. That was very well put. I need to know who wrote this. I need their name. Let's go, E-Trade. Peace and love. I hope you get rich. Consider joining the Patreon. Link in the description. We got the starting charting course. You get, the starting charting video series. It's not a course. It's a video series, very educational and informational, entertaining as well. We also have the swing trading checklist. If you are trading without a plan, I encourage you to join the Patreon and get an opportunity to see what a swing trading plan looks like. And I also go over that trading plan in the Patreon And if you join a little later, you'll be able to watch the video of that. You'll be able to catch up in the chat. We also got the strategy room. You can ask me questions directly. We can talk about things that are happening in the market and what I'm doing in response to that. And you can learn from my opportunities and choices, and you can learn from my mistakes as well. So peace and love. I hope you get rich. Link in the description. Subscribe to the channel, comment down below, like this video, and I'll see you in the next one.